you looking at all this, right? The developments in the Middle East, and this is coming off of a week of higher for longer. I mean, are we likely to see these risk-off moves continue on?
I think that seems most likely. There's always a danger in exaggerating conflict in Israel. It has occurred on numerous occasions over the last couple of decades, and it doesn't have a lasting impact on, say, oil prices or global markets. The real issue is whether it spreads and, say, Iran gets involved, or in some way it in turn threatens or reduces supplies coming from Saudi Arabia. So that's the thing to watch for. But in the near term, it's a factor that just adds to the uncertainty around markets. Markets are already on edge, share markets in particular, given the backup in bond yields, and obviously higher oil prices that might flow from this in the short term, and we don't know the full extent of that over the longer term, could add to that nervousness. So it's just another factor in the mix there that just adds to the riskiness around share markets at present.
Yeah, Shane, what does that mean? I mean, is it give investors reason to flock to safe havens like the dollar, or even back to treasuries, or should we fear another bout of inflation?
Look, I'm not so worried about another bout of inflation. I think the situation today is radically different. If oil prices continue to rise, yes, it directly adds to inflation, but the flow-on effect, I think, will be a lot less. If you look at commodities today compared to 18 months ago, many of them have been flat to down, even though the oil price has been trending up. And likewise, we don't have the supply shortfalls that we had. So I think a further rise in oil prices here would be certainly a negative, but it's more likely to act as a tax on spending and increase the risk of recession, which in turn is the main threat to equity markets, I think, going forward. So, yeah, the way I would see it is that it just occurs at a time when there's already a lot of risk around markets. It's a time for investors to be somewhat cautious, because we could see more downside in share markets going forward, even though ultimately it may not necessarily cause major problems coming out of the Middle East in terms of oil supplies, but it just adds to the risk of that.
Yeah. Shane, investor sentiment was already being hit to some extent. This probably makes it worse. So the thing is, one hopes it doesn't happen, but we could see the move to havens. We could also then see that sentiment becoming a self-fulfilling prophecy in a way.
That's right. These things often can become self-fulfilling. On our measure of investor sentiment, we've come from being high levels of optimism if you go back to August when share markets peaked. Now we've come back to around neutral. So there is history tells us that we're not yet at a point where you'd say, well, markets are going to go up because everyone's negative. They're not excessively negative yet. I think there's still some risk that can still be unwound. This risk-off environment could continue for a while. But yes, we do run that risk that it becomes self-fulfilling. Share markets through this correction, which I think has totaled about 8% from the top to the bottom, have so far been relatively calm. But obviously, as bond yields keep going up and risk factors keep piling on, as we've seen over the weekend with Israel, then the risk is that you can end up with a sharper fall in share markets.
Any signs of a bottom in either equity or bond market, Shane?
Look, I think it's a bit too early for that yet. There were some good signs on Friday, I thought, when you look at share markets bouncing off or just above the 200-day moving average in the US. So the share market had become oversold. It was on technical support. We saw that initial sell-off on the back of the payroll numbers. Then the market was able to rally with almost a 2.5% turnaround in the US share market through that session. So you can just say that that's a positive sign. But by the same token, the fundamental background of still rising bond yields, obviously threats to oil supplies, those things are quite negative. And it's hard to say that the bond market has similarly hit support yet. I think most technical analysts have it going up to 5% or thereabouts. And obviously, the higher the bond yield goes, then the more pressure it puts on equity markets, such that what we saw on Friday could turn out to be a false rebound, just a technical bounce as opposed to the start of a new, more sustained rebound.